Why you'll stay broke if you ignore this investment rule has nothing to do with intelligence. It has everything to do with behavior. The rule is simple: invest consistently and let time work. Most people delay, hesitate, and wait for certainty. While they wait, years pass. Money that could have been compounding sits idle. The cost of hesitation is invisible at first, but devastating over decades. This rule demands action before you feel ready. Markets will never look perfectly safe. There will always be headlines predicting crashes or bubbles. If fear controls your timing, you will always enter late or exit early. Consistency removes the need for prediction. Investing on a fixed schedule builds wealth without relying on emotion or forecasts. Ignoring diversification is another reason people stay broke. Putting all money into one stock, one idea, or one opportunity feels bold, but it increases risk dramatically. A single mistake can erase years of effort. Diversification protects progress. It may feel slower, but steady growth outperforms dramatic swings over time. Reinvesting returns is essential. When dividends or profits are withdrawn too early, compounding weakens. Growth accelerates only when earnings generate more earnings. The rule is simple: let your money stay invested. Every interruption slows momentum and pushes financial independence further away. Most people underestimate time. They want results in months, not years. But real wealth requires patience. Compounding is slow in the beginning and powerful later. If you quit during the slow phase, you never reach acceleration. Ignoring patience keeps you stuck at the starting line while others move ahead steadily. Another reason you stay broke is trying to time the market. You wait for prices to drop before investing, convinced you'll enter at the perfect moment. But perfect moments rarely appear clearly. While you wait, markets move. Often they rise without you. The rule is simple: time in the market beats timing the market. Consistent participation captures growth that hesitation misses. You also ignore the power of increasing contributions. Investing the same small amount for years is good. Increasing that amount as income grows is better. When your salary rises but your investments stay flat, you slow your progress. The rule demands growth in commitment. As earnings expand, so should your investment rate. Emotional reactions destroy long-term plans. A market drop feels like danger, so you sell. A market rally feels exciting, so you buy more. This behavior locks in losses and reduces gains. The rule requires emotional neutrality. Invest according to strategy, not headlines. Discipline during volatility separates wealth builders from spectators. Many people ignore costs. High fees, frequent trading, and unnecessary transactions quietly reduce returns. Small percentages matter over decades. Lower costs mean more capital stays invested and compounds. Ignoring this detail keeps growth slower than it should be. Finally, you break the rule by stopping too soon. Investing for 1 year is not a strategy. Investing for decades is. Wealth rewards persistence. If you interrupt the process repeatedly, compounding never reaches its full strength. Stay consistent long enough, and the results become undeniable. You stay broke because you treat investing as optional. Some months you participate, other months you skip. This inconsistency weakens momentum. The rule requires priority. Investing must come before entertainment, upgrades, and impulse spending. When you invest only what is left over, there is rarely anything meaningful left. Another mistake is focusing only on returns instead of behavior. People search for the highest performing asset, believing performance alone creates wealth. But behavior determines whether you stay invested long enough to benefit. A simple, steady strategy held for years beats a brilliant plan abandoned too early. You ignore emergency preparation. Without a financial cushion, every unexpected expense forces you to sell investments. Selling during stress interrupts compounding. The rule includes protection. Stability allows long-term growth without constant disruption. Many underestimate the impact of inflation. Money sitting idle loses purchasing power every year. Avoiding investment feels safe, but it guarantees gradual loss. The rule demands that your money works harder than inflation. Otherwise, standing still means moving backward. You expect fast proof. If results are not dramatic within months, you question the strategy. That compounding rewards patience, not impatience. Growth often appears small for years, then accelerates. Ignoring this timeline causes most people to quit just before progress becomes visible. You stay broke because you confuse activity with progress. Checking charts daily, switching strategies, reacting to news. This feels productive, but constant changes weaken results. The rule favors stability. Choose a solid strategy and stay with it long enough to let compounding work. Movement is not the same as momentum. You underestimate the savings rate. Returns matter, but how much you invest matters more in the beginning. Increasing your savings rate by even a few percent dramatically speeds up progress. Ignoring this rule keeps growth slow, no matter how smart your investments are. You follow trends instead of principles. Social media highlights fast gains and sudden success stories. Chasing them leads to buying high and selling low. The rule demands discipline over excitement. Long-term principles outperform short-term hype. You ignore tax efficiency. Taxes can quietly reduce returns if investments are structured poorly. Understanding basic tax strategies protects gains and accelerates compounding. Ignoring this detail slows growth year after year. You fail to think in decades. Wealth is built over long horizons, not short cycles. If your mindset resets every year, you restart progress repeatedly. The rule requires long-term vision. When you commit to decades, small fluctuations lose power, and steady growth becomes inevitable. You stay broke because you underestimate consistency. Investing once or twice does nothing. Wealth forms when contributions happen month after month, without interruption. The rule is repetition. Missing months may seem harmless, but gaps break compounding rhythm. Financial growth rewards those who show up regularly, not occasionally. You overreact to short-term losses. A temporary decline feels like failure, so you pause or withdraw. But volatility is normal. The rule requires understanding that downturns are part of growth. When you stop during declines, you lock in losses instead of positioning for recovery. You ignore asset allocation. Without balance between risk and stability, your portfolio either grows too slowly or swings too wildly. The rule demands structure. A balanced allocation protects against extreme outcomes and supports steady expansion over time. You fail to review and adjust. Consistency does not mean blindness. The rule includes periodic evaluation. Annual reviews help rebalance, reduce risk, and align investments with changing goals. Ignoring adjustments weakens long-term strategy. You expect motivation to last forever. Some days investing feels exciting. Other days it feels pointless. The rule survives beyond emotion. Systems and automation ensure contributions happen regardless of mood. Discipline, not excitement, builds wealth over time. You stay broke because you wait for extra money to appear before investing. There is always a reason to delay. Bills, plans, uncertainty. The rule says invest with what you have now. Even small amounts build the habit and activate compounding. Waiting for the perfect surplus keeps you permanently on the sidelines. You underestimate the damage of lifestyle inflation. As income grows, expenses quietly expand with it. Better apartment, newer car, higher standards. If investments do not grow faster than lifestyle, progress stalls. The rule requires controlling expenses even when earnings increase. You focus on price instead of value. Buying assets just because they are trending or cheap leads to weak decisions. The rule demands understanding what you own and why. Knowledge reduces panic, increases conviction during volatility. You let short-term news influence long-term strategy. Headlines are designed to trigger emotion. The rule ignores noise and follows a structured plan. Reacting daily to news cycles disrupts momentum and weakens discipline. You quit after small setbacks. A bad year, a small loss, or slower growth feels discouraging, but compounding rewards endurance. The rule requires staying invested long enough for recovery and acceleration. Persistence transforms average returns into meaningful wealth. You stay broke because you underestimate the math. Doubling money at reasonable returns takes time, but it is predictable. The rule is simple arithmetic. Consistent contributions plus compounding equals growth. When you interrupt the equation, the outcome changes. Wealth is not mysterious. It follows formulas. Ignore the formula, and the result is stagnation. You prioritize consumption over ownership. Every purchase either builds assets or builds expenses. The rule favors ownership. Stocks, businesses, property, productive tools. Consumption feels rewarding today. Ownership rewards you for years. Repeating consumption daily guarantees you fund someone else's wealth instead of your own. You avoid discomfort during downturns. Investing when markets fall feels risky, even dangerous. But downturns often create the best long-term entry points. The rule requires courage when others hesitate. Discipline during fear creates advantage later. You treat investing as gambling instead of strategy. Chasing hot hits, speculative moves, and quick wins introduces randomness. The rule rejects randomness. It favors structured allocation, long horizons, and measured risk. Gambling creates stories. Strategy creates wealth. You ignore personal growth. Increasing income expands your investing power. Skills, negotiation, entrepreneurship. These multiply capital. The rule combines earning and investing. Without growth and income, investing remains limited. With both aligned, wealth accelerates dramatically over time. You stay broke because you don't separate capital from spending money. Every dollar feels available. The rule requires division. Investment capital is untouchable. It is not for vacations, upgrades, or emergencies. When you treat invested money sacred, compounding remains uninterrupted. When you treat it as flexible, growth constantly resets. You underestimate the psychological side of investing. Fear, greed, impatience, these emotions quietly sabotage strategy. The rule demands emotional awareness. Recognize impulses before acting on them. Mastering your reactions often matters more than mastering the market itself. You fail to think in percentages. A 1% fee, a 2% improvement in savings rate, a 3% annual raise. These seem small. The percentages compound over decades. The rule respects small numerical advantages. Tiny improvements, sustained long enough, create massive differences. You lack a clear target. Investing without a defined goal weakens commitment. The rule includes purpose. Whether it's financial independence, early retirement, or security for family. Clarity strengthens discipline. Goals give consistency, meaning. You expect comfort during the process. The wealth building often feels boring and repetitive. The rule rewards endurance through monotony. Excitement fades, routine remains. Those who accept the boring middle stage are the ones who eventually experience extraordinary results. You stay broke because you reset your strategy every year. A new trend appears, a new prediction sounds convincing, and you abandon your plan. The rule demands stability. Constant changes restart progress and weaken compounding. Wealth grows when strategy remains consistent through different market cycles. You ignore the power of long-term ownership. Selling too early limits growth. The strongest returns often come after years of holding quality assets. The rule rewards patience. Selling at the first sign of profit may feel smart, but it often sacrifices exponential gains later. You focus on what others earn instead of what you built. Comparison creates distraction. The rule emphasizes personal trajectory. Your financial growth depends on your discipline, not someone else's portfolio. Energy spent comparing is energy not invested. You underestimate reinvestment speed. When dividends or profits sit idle in cash, momentum slows. The rule requires immediate reinvestment. Idle capital loses time, and time is the strongest growth factor you have. You fear starting imperfectly. Waiting to understand everything delays action. The rule favors learning while investing. Small beginnings create experience. Experience builds confidence. Confidence strengthens consistency. You overcomplicate the process. Complex strategies feel advanced, but simplicity often wins. A diversify, low-cost, consistent approach outperforms frequent changes. The rule prefers clarity over complexity. You forget that discipline compounds too. Each month you follow the plan, your confidence increases. Confidence strengthens commitment. Commitment builds momentum. Ignoring this cycle keeps you starting over repeatedly. If you ignore the rule of consistent, disciplined investing over time, you remain dependent on income alone. But if you follow it, investing regularly, reinvesting returns, managing risk, and staying patient, wealth becomes predictable. The difference between broke and financially free is not luck. It is adherence to the rule.